Most investors fear volatility. They see it as a wild roller coaster that they can't control or predict. But what if I told you that volatility, when harnessed correctly, can actually generate wealth? This isn't just a theory, it's a proven mathematical strategy called Shannon's Demon. And today, I'll show you exactly how it works. Claude Shannon, one of the greatest mathematicians and the father of informational theory, proposed an investment strategy in 1960. He called it Shannon's Demon as a playful reference to thought experiments in physics like Maxwell's Demon, which describe ways to extract order from chaos. In this case, Shannon's Demon exploits market volatility to systematically increase wealth. Since then, Shannon's principles have influenced portfolio management, algorithmic trading, and quantitative finance, as well as systematically used in volatility to increase returns regardless of whether the market trends up, down, or sideways. Here's how it works. Imagine you have two assets. One is a volatile stock that moves randomly up and down. The other is a stable cash position with zero return. Instead of just holding the stock and hoping for the best, Shannon's strategy does something different. It rebalances, systematically selling when the stock goes up and buying more when the stock goes down. Let's break this down with a simple example. Suppose you start with $50 in a stock and $50 in cash. Now let's say the stock jumps 20% and your stock position is now worth $60, while your cash position remains at $50, bringing the total portfolio to $110. At this point, Shannon's Demon steps in. We rebalance back to 50-50 by selling some of the stock and moving $5 into cash. So now you'd have $55 in the stock and $55 in cash. Next, let's say the stock drops back down 20%. Instead of losing the money like a buy and hold investor, you actually come out ahead. That's because your lower stock price allows you to buy more shares with your cash reserve. After repeating this process over time, your portfolio accumulates wealth from volatility itself. Think of it like a farmer managing his wheat harvest. We'll call this farmer Connor. If wheat prices rise, the farmer sells some of his grain for cash. If wheat prices drop, he uses that cash to buy more wheat while the price is cheap. Over time, he accumulates more and more wheat, just like how rebalancing lets an investor accumulate more assets through the market's normal ups and downs. To further ingrain this concept, I want to show how diversification is the only free lunch in investing. It is the only thing that by doing so and diversifying through your assets, you get an exponential decrease in risk and an exponential increase in return for essentially no additional risk and not sacrificing your return whatsoever. To show Shannon's Demon an example of volatility drag, I want to show how two assets with a $0 expected return can create edge. The first is a coin flip game. When we get heads, we will realize a 50% return. And when we get tails, we will realize a 33% return. Due to drawdowns and volatility drag, from a 33% drawdown, we need a 50% return to get back to even. Cash, excluding inflation, $50 will always equal $50, and the US dollar will maintain its value, or therefore in cash. Both of these have a $0 expected return. To show this, we will show not using Shannon's Demon and not systematically rebalancing. In this example, over 6 flips, we had 3 heads and 3 tails. Over the course of this, we constantly win $25, lose $25, win $25, lose $25, win $25, lose $25. You can see that over these 6 flips, we just constantly fluctuate between 125, 100, 125, 100, 125, and 100. We can all agree here that there is no edge in this game, and both assets have a $0 expected return. This further shows the volatility drag that as we get larger drawdowns, it takes an exponentially larger return to get back to even. We can see with a 5% drawdown, we need a 5.3% return to get back to even. The 10% drawdown, that nearly triples. Then when we look at 50% drawdown, we need a 100% return to get back to even. And showing the 33% drawdown, we need a 50% return getting back to even. This chart on the right shows that if we were to play this game 100 times without rebalancing, we would have a $0 expected return, just constantly fluctuating up and down to eventually reach 1,000 with no variation in the win, just switching wins and losses. Now let's look at the coin flip example, but this time we will rebalance into the assets using Shannon's Demon's concept. In the first flip, we have $50 in each, and we win. Therefore, we return 50% on the coin flip game, and we maintain our value in cash. We now have a balance of $125, and we will split this and rebalance it 50% into cash and 50% of the coin flip game, having $62.50 in both games. On the next flip, we lose, incurring a 33% drawdown or losing $20.83. we now have a total return of $104.17. We again rebalance, even though we lost 50% in cash, 50% in the coin flip game, having 52.08 in each game. We then win again, winning $26.04, or therefore 50% return. Now we have a total of $130.21, rebalancing again into cash and again into the coin flip 50-50, having $65.10 in each. Then on the fourth flip, we take a loss, losing $21.70. We now have a total account balance of $108.51, again rebalancing 50% of the coin flip game, 50% in cash for $54.25 in each. We win once again, winning $27.13, now having a total account return of $135.65. We now rebalance again, $67.82 into cash and $67.82 in the coin flip game. On our last flip, we lose, taking a 33% loss or $22.61, having a total now of $113.03, again rebalancing. You can see here that we ended up with a balance of $113.03, having 1, 2, 3 wins, which are heads, 1, 2, 3 tails, which are losses, comparative to the initial game where we had the exact same 3 wins and 3 losses, and therefore we ended up with $100 instead of $113. Nothing changed except we rebalance, and this quantitative concept of Shannon's demon came into play. For the final result of $113 versus $100, a 13% additional return on our portfolio just simply using Shannon's demon. This is overemphasized from volatility, but what I want you to understand is 2 assets with a $0 expected return, when managed correctly and harvested for volatility, can provide quite the additional return, as well as doing this in 0DT options with the speed of it gives this benefit much quicker. The next part here is showing 1,000 random occurrences in the breakdown. You can see in the top here with the path dependence of never rebalancing. Some people will inevitably make a huge amount of money. Some people will in turn go broke. And across the mean, it's basically noisy, and this is investing through luck. Most people's strategy in general. Then if we look at the bottom portion, simulating 1,000 random simulations, you can see that rebalancing, you're almost certain to make money over time. It does take some people longer, and even the best of us may not have quite eclipsed the returns of the extremely lucky people. But you can see which camp you would rather be in, trusting the math or playing on luck. This is why Shannon Demon work, and this is how I recommend doing this in real life for your portfolio. To show a quick example of how this works, this is our tail risk hedge, which is a long volatility suite that we run. You can see here that it has a 10% return and 8.4% drawdown. Now, if we add in the credit portion of this trade holding overnight to finance that long vol hedge, we now have a 15% return with a 5.5% drawdown, further increasing our drawdown to 13.9% and our return to 25.9%. After that, we have our 0DT trades, which again have a drawdown of 1.6%, boosting our drawdown to 15.5%. Then we have our 0DT trend following, which has a drawdown of 2.1%, boosting our drawdown to 17.6%. But what happens when we combine all these? Well, the concepts of Shannon demons come into effect and give us a better return through rebalancing through all of these as they go in and out of favor, reducing our drawdowns much less past 17.6%. The final result is we go from a uncombined version of 59.9% return with a drawdown of 17.6% to a combined version of all these uncorrelated strategies to have a 67.8% return with a 5.8% drawdown. This is in turn Shannon's demon at work and how I recommend people think about investing through uncorrelated strategies and strategic options like 0DT rather than just blindly trying to play the luck on 10-year bull market. Shannon's demon works because of volatility harvesting, turning market fluctuations into profit through disciplined rebalancing. Unlike a typical buy and hold strategy that suffers from downturns, this method profits from the market's turbulence. Let me tell you when this really clicked for me. I'd always thought that to make more money, I'd take more risk. But then I realized something counterintuitive. I could put on a hedge that loses money and somehow it actually improved my portfolio results. Or by holding cash and taking less risk, I could actually make more money over time. This was a game changer. It showed me that the key wasn't just making the right bets, but managing those bets in a way that leveraged volatility instead of fighting against it. In modern quantitative trading, we apply Shannon's principles by pairing assets with uncorrelated volatilities, such as stocks and bonds, or even different option strategies. The key takeaway is that instead of fearing volatility, sophisticated investors can exploit it for long-term gains. Most investors let volatility work against them. Shannon's demon shows us how to turn it into an advantage. If you're looking to implement volatility-driven strategies in your portfolio or want to see how hedge funds use this at scale, subscribe to my channel or visit my website. Like, comment, and subscribe below. Thank you.